Okay, good day everyone and welcome to our educational webinar, proudly brought to you by the International Trade. I am and I am delighted to be your host for today. Before we proceed, please confirm in the chat if the audio and the visuals are clear on your end, and let's take a moment for your response. Okay, perfect. Thank you for that, guys. Today's session promises valuable insight on achieving funding and financing in the new economy. This webinar specifics of packaging transactions, how to adjust to changing banking structures, top-down analysis of transactional financing, adjusting and adding to the capital stack, tactical financing reality versus strategic goal. And for that webinar, we're honored to have Jonathan Poppy, CEO of BX Global Incorporation, as our esteemed presenter. Jonathan brings extensive expertise to the table, and we're eager to learn from them. Without further ado, I'll pass the virtual stage to you, Jonathan.
Okay, welcome. Thank you for tuning in, and I'm glad to have you. And hopefully that we can help you in your journey to understand the new markets as they have changed drastically over the last 4 years. And there are new sources available, and I'm going to give a better overview of the marketplace, other than just working with the banking structures. But what I'm going to do is to cover the why of it. And so the first thing that we're going to cover is changing banking structures. Then we're going to cover in this transactional financing, um, assessing the capital stack that your company has, and tactical versus strategic financing, which are all important when you're trying to maintain operations and fluidity in the market. So right away, we're going to cover the banking sector simply because it's necessary to do that to understand the why of what happened. So pre-COVID, um, there was a lot of capital in the market for trade transactions, and a lot of the international banks were participating. And then during COVID, what happened is of course we had supply chain issues, and the terms that were coming from China on shipping had changed drastically because the Chinese banks, or the CCP, had started to demand payments up front for manufacturing, because the trade letters of credit weren't honored all the time, and so there was multiple logistics issues, and that became retrenchment for a number of foreign banks and the U.S. banks and the entire banking system. And what that translated into was a higher risk factor, so that higher rates were part of the process to weed out those companies that couldn't pay those higher rates. And then stricter underwriting came into play. So the processes became longer. So this became a kind of a double death blow to a lot of the previous more fluid capital that was available to companies, particularly purchasers and manufacturers, in placing their orders. The trade financing went downhill, and then private equity pulled out of some of the more riskier underlying funds. So what happened was there was a reduction of probably more than 30 to 40% of available capital overall. We're putting that together in a brief, and we'll have that brief for you. The other issue that came up, sorry about that came up is capital flight. So what happened during capital flight was that certain countries had experienced change in the amount of capital available for manufacturing and for other services. because people were moving capital around. So that became an issue as far as liquidity is concerned, and country banks were having a difficult time understanding where the next dollar was coming from, or whatever currency standard they were using. So that those top three dynamics really affected the process of deploying capital. And then what was then the cause? That was the cause, and then the effect. So the effect was bank risk and bank retrenchment. And so what happened was that the banks wanted to delever out of several of their riskier positions, and international trade was one of them, because in certain cases bills weren't being paid. There's a problem now in Mexico with some of the maquiladores not being paid on time, and we'll get into those issues separately. And then what we call retrenchment. So in other words, the banks were either altogether pulling out of the market, or they were increasing the above, which is the stricter underwriting, and also deploying higher rates because their risk was higher. And so they had to mitigate that risk and had to justify that to the bank. And so part of this is understanding that banking leverage and how that works. So when banks are healthy and banks are strong, and the central banks and the key banks are all, performing well, there's not a lot of economic upheaval in the market. Banks have leverage, so they can usually go to the central banks, and they can, here in the United States, it's the Federal Reserve, and they go in and they get capital on the basis of how much they have in deposits. So with all of the above, and plus people taking money out of banks, the system really took a shot, and it still hasn't fully recovered yet. The worst of it is over from my predictions, but it's still not back to being where it should be or where it needs to be. So we have to understand what we're dealing with. And the reason I wanted to bring this up and adjusting to this is that you can't fault the banks for doing this, because they're trying to protect their bottom line. But you do need to understand it. And if you understand the fact that they're looking to de-risk their transactions and the executions of short-term loans, especially when it comes to trade finance, then you can understand how to put a package together that makes you look like a very worthy candidate. And that is part of the problem that we saw in the marketplace, is that packaging wasn't put together correctly. We're going to address that much later in the presentation. But I wanted you to understand that as an underlying topic. So now that we know what the problem is, we can move on to what's the solution. So the solution is to seek out alternative resources, which include the private credit markets, subprime financing, there's debt equity funding. We're also going to be covering purchase order funding and some other forms. So this comes under the banner of a short-term financing or trade financing. We want to call it transactional financing. And there are several markets for you to look at. One is your subprime markets. Your subprime markets consist of your purchase order funding guys, and also your account receivable AR funding. Some of you should also be looking at the private credit markets, where there are funds out there that do form one-on-one relationships with companies that have solid track records, so that they can lever up and access capital at a reasonable rate, with terms that are going to be transactional in nature and focused on the task at hand without damaging the company. The other part of that private credit market is to be aware of debt equity funding. And debt equity funding allows you to establish a relationship with either private lenders or in the private credit markets, where you're actually fortunately or unfortunately going to give up some of your ownership for solid debt financing. So in other words, you might want to be doing discovery to find out whether or not you can qualify, where they'll give you the money, they give you 100% of the capital, and they wouldn't be asking for 100% of it in return right away to give you leverage and more working capital, but they're going to take some additional stock in your company or position in your company, or push that out to a future payday so that they can see that. Those are good relationships. They can be bad relationships. They have to be examined on a one-on-one basis, but they are out there. They do exist, and we look forward to helping you with how to go about that and what sources there are available. The specifics of of this type of funding, there are your trade advances, which I'm going to go in depth here on. Your purchase order financing, again, I will go fairly in depth on that. Accounts receivable, your trade, and I'm also going to cover why trade guarantees, letters of credit, and insurance are important. So trade advances are something that you could look at. They can come in two forms. So they can come in the form of a short-term cyclical financing. Again, this previously was dominated by the banks, and it's no longer, and that's kind of not true right now, but they still exist and could come back. But a trade advance, is simply put, is if you're a manufacturer and you're ordering 3 different kinds of parts to provide a finished product to an end buyer, and that end buyer is certified, and you have a track record, that either you can work out something with those 3 manufacturers from a timing basis. That would also, because that would be considered a trade advance, and also from your buyer, and working out terms and conditions. And I will go one-on-one with anybody who wants to learn about this to do this. And that will allow you to essentially solve the problem of putting out 100% of the capital required to manufacture and distribute the product, and allow you to actually get that purchase order completed, which can be taken care of with the other types of financing, so that you can maintain and continue operations without worrying about it. Your purchase order financing plays into that, in the fact that there are purchase order sources that we do have, that we've worked with in the past, that will fund your purchases, given you have a purchase order from a large enough entity that has great credit, and that they can verify the transactional status in the back, and do a background check on that company and make sure that the ordering company is solvent. So in purchase order financing, your track record is important, but what's more important is the client background and history. So the way that you need to approach purchase order financing is you need to have a very well done profile of the buyer. So that would include all of the buyer's information. You don't necessarily need the financials if it's a big enough company, but that buyer has to be on either Dun & Bradstreet, one of the major reporting agencies, available through international search, and they may be contacted, and their credit is going to be looked at versus your ability. So both are going to come into play, and you have to be able to prove out both. But if they've got a bad track record and they haven't paid off some of their bills, then you probably shouldn't even take the purchase order. Accounts receivable financing is a little bit different. Some of you are probably familiar with it and have done it before, and you know it's short term. And you want to stay away from long-term contracts if you can. But it can be very effective. And accounts receivable financing is, you ship the product, the shipper's taking control of the product at the dock. It's on its way, and therefore that's an actual invoice to be paid within, let's say, 30 or 45 days. And in that case, what happens is you get the advance from anywhere from 60 to 80% of what that actual accounts receivable invoice is. And then they collect the balance, typically in their lockbox scenario, and forward you what's left minus your minus your fees and costs of that capital. Typically, you want to be able to set aside, at least 2 to 3% as a figure for per each 30 days. If you're doing purchase order financing and you're doing accounts receivable financing together, in other words, let's say 50% of the capital came into your company in order to manufacture, and then you manufactured and then you shipped out, and then that becomes an invoice and you went through and got the accounts receivable, well, then you're probably looking at 5 points. So we're going to cover this topic about how to use this financing, because you have to have the profit margins built into the process, or back charge your customer for the financing that you have to take down because they can't pay in advance. Trade guarantees, letters of credit, and insurance. I'm sure you're all familiar with letters of credit. Is basically the issuer bank agrees that you have the capability to pay on the invoice, on the purchase, or on the purchase of manufactured goods from their bank. And what that does, it gives us a sense of safety to the situation. And also we can cover insurance. And so one of the insurances I want to cover here today is the Export-Import Bank of the United States for U.S. manufacturers that are shipping overseas. I'm not as familiar with other governments that may or may not have this in place. But if you're a U.S. manufacturer and you're shipping overseas, the Ex-Im Bank will guarantee your payment up to 90% or 95%, just depending on the underwriting. And so they'll do the underwriting on that. And what they'll do is they'll look at the buyer and make sure that the buyer's solid. And then if for some reason the export goes awry and you ship it and you don't get paid, or you don't get paid on time, you can execute that insurance, the Ex-Im insurance, and get paid. So that's a great tool to have if you're approaching banks and others to make them feel comfortable that, in fact, you're going to be able to pay them if there's a default on the other side. I'm going to go. So what we're going to do now is cover the importance of packaging and why it's so important. And that goes back to the first introductory part of this webinar, which was how do you make a bank or any financial entity feel comfortable with you? So if they don't understand that you have the capability to deliver or execute, then there's going to be an issue because they don't believe in you in the first place. So you have to give them reason to. So one of the top things that you can give them is historical operating performance in the past. And what this includes is your existing client base, maybe some references or samples of transactions. If you want to keep information confidential, you can do that. I would suggest that you would register with Dun & Bradstreet or one of the other due diligence providers that are out there, so that can be monitored. And they're probably going to want to see terms and a sample of your invoices or purchase orders and subsequent fulfillment. So if you were constantly running behind, but there was a reason that can be explained, that's fine. If you're defaulting occasionally, or there's issues with how your packaging is put together, then that's going to create an issue where the underwriting department of that financial entity or institution doesn't understand what it is that you're trying to accomplish, because they don't believe that you have the capability to perform. So my suggestion to you is, and this is an important part of this, is to keep not only your financial statements up to date, but it's also to keep your the track record and execution on the sales side and on the performance side of what you've done. So those KPIs are important to track. So are your AR aging reports. So are your accounts payable reports. So are your delivery reports. Any documentation that has been or should be recorded and kept in a virtual data room for them to look at, to ensure that yes, in fact, when you took on a contract, you were able to deliver. You delivered a quality product. Everybody was paid on time, given whatever hiccups or problems came up in the process, and that you were diligent in tracking that information. So just like anything else, you would want to know what that looks like, and there are specific documents that you want to have available. So obviously you want to have your banking statements available. Obviously you want to have your profit and loss. We're going to get into this a little bit heavier in the next slide or two. And you want to be able to show through purchase orders, invoices, timings, and also possibly your accounts receivables payment times, that you're running on a track, so that at least there can be discovery involved in that track. So you might have certain issues. So I don't want to scare you off from applying for financing if there's issues, but those issues can be explained, and they can be explained by record. So it's important for you to keep a cylindrical funnel of documentation available for that underwriter to review, so that they understand the risks and the downside, and also understand that you are in fact capable, and that you have revenue streams and transactions that can prove this out. So the required documents and disclosures for that, I again will go back to the standards. You want transactional information in there. You want profit and loss statements to be current. You want your balance sheet to be current. You want to have, if you can, some capital reserves that show you have the ability to pay should there be a default. And then if you can provide a sample of your invoices and purchase orders, etc., that's also going to be helpful. The other documents that are going to be required are corporate documentation, just to prove operations. And those of you who've been through the underwriting process know that it's more than probably is necessary, but that is what's required by these funders, because they're the ones that are taking their risk with their capital, and you have to understand that. So in doing that, though that packaging could change a bit if we go to transactional packaging, and we're going for debt, or we're going for equity, or we're going for a combination of debt or equity. So transactional packaging versus the above, even though that has to be kept in place, is going to be based on, one, I have a purchaser, and I have to manufacture, or there's a trade agreement involved and in place. The transactional packaging needs to be transparent, and it needs to show that both parties have the capability to execute. So if there's hidden documentation, if there's confidentiality agreements, those things need to be handled up front, because you're going to have to show all of your cards, both internally and externally, in order to get the capital. So this is not a situation where the meal can be custom ordered, simply because they're the ones that are taking the risk. And I'm going to continue to harp on that, because it's not about you. Honestly, it's about them and what they feel and what they see, and their ability to recover capital in a worst case scenario. Transactional packaging focuses fairly much on the transaction. So in other words, if I have a product with a 40% profit margin and I've sold it 3 times already, and I can show that I have a good track record, you're probably going to get your money. If you have a product that's got an 8% profit margin, and you've only done this twice, and there have been hiccups with both, you're probably not going to get your money. So you want to be looking at that when you go to market, and that's something that you need to find a solution for. And I know with the currency fluctuations recently, that's also we're going to cover that, but in another webinar. Currency fluctuations have also kind of damaged that situation as well. So that's transactional packaging. Debt packaging is much different. Debt packaging, again, will be what we previously covered with the historical operating performance, the required documents and disclosures, and then, of course, all the corporate documentation, and that can get pretty invasive, and I can give you a full list of that. Just go ahead and put your information in the chat. And then equity is a different animal altogether, where the company is going to sell to the equity markets, and there is a process of either a registered or exempt securities in order to do that. And that, again, is something that we want to look at that's private and is also confidential. There's a little less disclosure that has to be made other than the highlights of it, because what they're doing is they're not taking a risk in the transaction and they're not looking for a payout. They're actually investing in the company's performance, and the company is turning around and using that capital to augment operations and pay for some of the cost of the manufacturing or the purchase orders or operational capital. And so therefore what happens is they're in a longer position to sit, and they're believing in the company's ability to grow in an exit strategy to be announced later. So in our getting down to the grassroots of the this, and I apologize for the misspelling, tactile usage versus long touch. Should have been tactical, by the way. I didn't catch that. I apologize. The analysis of strategic finance is important, and we're going to get into a little bit of case study here. So there's the pros and there's cons, the added cost of either short-term financing or long-term financing. So one of the things that we have to look at, the most important thing to look at, is how are we managing the long-term picture of adding strategic financing, and also managing the margins. And I'm going to have to apologize. This last slide slipped in and wasn't proofed, so I'll apologize now for that. But it has weight. So the pros and cons of the added cost are this. So the pro is, if you've got a 20% profit margin and the financing is costing you 4%, you can pretty much rest assured that you're going to be making some decent money on that transaction, right? So 16% is not bad. I'm just giving you an example. In a 1 or 2 time or 3 time situation, that may work and be effective, and that's just fine. It can be where it affects your bottom line if you don't have a significant profit margin and or you continuously use this, because once you make 3 or 4 turns of capital with this, you should be working on your strategic relationship and trying to get trade advance terms as part of the process, and also be looking at this, do I want to maintain this added cost? So that's where we want to look to long-term financing, which would be lower in as far as the interest rates are concerned, but you're also taking on a longer term debt structure. So you want to be able to, as you look at that, you want to be able to what we call manage the margins, and you want to use it tactically versus long-term debt. So if I have a purchase order of $1 million and it's costing me $600,000, and the manufacturers are giving me net 30, and all I'm having to do is put in a 10% down payment, what I need from that is 500,000. Let's call it 500,000. So I need 500,000 now. So I go back and I take down 500,000 on what's costing me 600,000, and so I'm only paying that 4 or 5% on that 500,000. And so therefore the overall usury on that is lower because I'm not using the whole thing. And as I gain momentum with those types of financings, I can set capital aside so that becomes lower and lower and lower. And that's what you want. That's how you want to use strategic financing. So if you're doing, let's say, purchase order financing and accounts receivable financing, and you've got trade advances, et cetera, if you take the total cost of that package up against the total profit margin, then you would want to end up somewhere blended around 2.5 for the transaction. If it goes above that, that's okay. But again, be aware that over term, that gets to be a very expensive proposition. And what I would recommend, if that's something you have to do because of your the way you're structured, or let's say you're just starting out, then you want to be courting long-term sources of capital and banking sources to show them, hey, we performed, we're paying too much capital at this point in time to execute on these transactions. And what we'd like to do is to get into a longer-term relationship with a revolving line of credit, and maybe that on an annualized basis is 8 to 12% in the markets now. But you're only taking down what you need and only paying on what you take, versus having to pay 4 points on an entire transaction. So that's important stuff to remember. I'm going to go back and I'm going to kind of go over the salient points of this, and I did move through this relatively quickly. But what I want to kind of make sure that you understand is that number one is markets have changed, so you need to adapt and change with the markets. They're not going to change back anytime soon. So part of that is making sure the first thing that you do is put a good package together. This means an executive summary of your company. You're going to be required to provide bank statements anywhere from 6 months to 2 years. You're also going to be able to, in some cases, need reviewed or audited financial statements that need to be clear and concise. You're also going to need to provide your transactional history and disclose, in some cases, unless it's extremely confidential, you're going to have to disclose what your client base looks like. And because they're going to need to know who you're dealing with. So, and if you can't do that, then that makes the process more difficult. The second step of that equation is to make sure that you're constantly recording your transactional history, what your profit margins are, what your costs are, what your unforeseen and miscellaneous is, so that moving forward, we can graph, or you can graph your historical operating history and the profit margins and see where things have gone. Some of you lately have probably been hit with currency or exchange rate issues, especially with the United States or other countries that you're doing business with. And so it's more expensive for you, and your profits have dropped because your purchaser doesn't want to change or go up. So my recommendation to you in the future is, when you contract, is to have a currency exchange amendment in there that allows for you to move your ask up or your invoices up with the rate of exchange on the currency, because it's very similar to inflation. Inflation goes up and your currency changes. Now, all of a sudden, what was 18% is now 7%. And that creates quite a big problem if you're a major manufacturer or supplier. So those are things that can be done. I would recommend that you either talk to me to help you get them done, or get a professional to help get them done. But those are things that you need to consider. So that is coverage as brief as I can in this, and I'll go ahead and I'll open up the chat to questions. Lady Ann, do you want to?
Yes, I'm here. So, guys, if you have any questions about the presentation of Mr. Jonathan, you can definitely type in on the chat box or in the Q&A tab. And to answer the questions for Kenton Johnson, we understand you by that. However, I wanted to inform you that this is a live session and also it was recorded, and you can definitely watch this on our ITC YouTube channel. So let us wait for some question and answer. Okay, so here I saw a question here. So let me. Okay, so hi Jonathan. The question is here, Jonathan. So, what are the strategies for securing funding and financing in today's economic landscape?
Well, what it does is it starts out with a strategy and an internal look into the company's needs. And then from there, you want to take kind of a three-pronged approach to the market that includes soliciting known sources of trade financing, the banks, the larger purchase order funders, the largest accounts receivable funders, depending on what your needs are. And so, the other issue is the private credit markets and understanding that landscape as well. So to be specific in that, you need to reverse engineer the process. So instead of asking who do I go to, you have to look at yourself and say, what do I have? So do I have a good track record? Are my margins solid? If I don't, then where do I fit in that risk profile? So if you have a higher risk transaction, that means you have to go to higher risk sources. So um, I would suggest that you start with yourself, and then once you go through that and look at your, what that looks like, then that's going to give you a better idea of who to go to. So if it's higher risk and higher return, then you're looking at more private sources. If it's something where it's everything is not only calculable but transparent, then you can go to more institutional or traditional sources.
Thank you so much for that, Jonathan. So, okay, let me check if there's any questions. So, guys, if you still have a questions, Jonathan can be definitely answer that one for you.
Okay.
Okay, so I
Okay.
saw one
If,
question
if
here. So the question is, there a significant difference between Asian and European trade finance we see to see the we set to see the different or the very difficult dealing with correspondent banks.
absolutely, the rules and the differences between the Asian and the European banks, um, you know, a lot smoother previously, but they're both facing new sets of challenges. Depending on when you say Asia, I'm assuming Chinese. I mean, Asia's big continent, but the European banks have had an issue on the risk side dealing with the Asian banks, even though there isn't that big a chasm, and probably Asia is a little bit stronger than Europe is now, and that so what that goes to retrenchment. That, in other words, it's not that the transaction's a bad transaction. It's just that you have to find that European um, and or Asian bank that familiar with international trade financing versus a bank that's just familiar with your company. And if you're talking about the correspondent banks, not being able to communicate and not being able to transact, that's a huge issue. And you have to be able to look I would like to be able to give you a specific solution to that problem, but I can't at this point in time. Uh, at any rate, just to finish off, is that what you have to search out who has an international trade finance understanding, and so not all banks do. And so your mission is to see if you can uh, uh, find a bank that's going to be able to work with you a little bit better and is educated on international trade finance, and will work with your bank, or you need to find a new bank that will work with them, one of the two.
Thank you
Okay,
so much
so
for that, Jonathan. So, upon checking here that also Kenton Johnson inform or tell there's a chat. Your emphasis on presentation. Let me go ahead and check this one first. So, your emphasis on preparation is very important. Too many are hoping and wishing that their great product or idea will overshadow poor
yeah, so I mean that's just a fact-based statement, and that's true. That's why I mentioned it. Is like I think too many companies come into this, and they want the finance company to do all the homework, but they don't want to cooperate. That's not professional. And this goes back to my original statements of, look, they're doing you a favor. You're not doing them a favor by giving them business. So it's important that um, you don't come into the situation unprepared, and you just come in with very little information, and you're not disclosing information. Nothing's documented, because if you do that, then your packaging is really bad. It doesn't matter. You could have a great business, but they have no way to know that, and they have no way to calculate their risk. So you have to help them uh, in that process, and you should prepare that prior to entry into the market. And then I saw a question here. From Chrysanthus, and then one from Anna.
Yes. So here for Anna, I am using my contracts as collateral to pay off loans. What do you think of this method?
Well, that's essentially what trade finance is. That's accounts receivable or purchase financing. Is those are the invoices, or in trade finance, advances on a service contract or any contract. That's the standard definition right there. So as long as you have enough profit margins inside of your contract, you should be fine. You don't want it to be a permanent transactional. Transactional financing is expensive, so you don't want them to be permanent. So you have to start to plan now for some type of escape from that in the future, and building that background and building that packaging, that transactional information, so that you can escape it and get into a more traditional trade line of credit or line of credit.
Okay. So thank you so much for that. So this question is from Chris Santos. Hi, Jonathan. Why there a global craze in equity financing of fintech startups while neglecting other sectors which are key drivers of the economy and backbone of the fintech stimulation?
Well, that's that those equity markets are really separate. Private credit markets and private equity. You're talking about venture capital, and actually, it's coming down. The latest statistics are that's um, reducing. There was a fintech craze because there was a lot of emphasis on fintech. There was some acquisitions. There was a couple of IPOs. There's companies who've made a lot of money in fintech, and then now that's kind of where the industry's gotten a bit cloudy as far as all the new products that are on the market. I mean, we use fintech. We are fintech in some way, a little bit different than we're not consumer based, but we're private equity based, and in finance based. We have a SaaS system that we use and have built, but that's going down. I understand the frustration of watching a company that doesn't have a solid business plan, it seems, get millions of dollars and then you're not able to get any capital at all. I've never been able to explain it, and I don't work with venture capital firms at all. So I feel your pain, but I don't think that it's going to be a long-lasting thing. Already the numbers are coming way down. So and the good thing about the tough economy is that fund managers are coming back down to earth and looking more at fundamentals now. So I don't expect there anytime soon to be monumental shift, but I do expect that there'll be a shift in available capital to more mundane and more relatable businesses, as it were.
Okay, thank you so much for that, Jonathan. And also, upon checking here that, yes, oh, here, for Amna, I have a small scale business. I produce handmade jewelry. What are the possibilities and funding opportunities?
Okay. I know somebody who does that as well, as a matter of fact. Personal friend of mine. I think she's on here. It if you're selling to the consumer, I'm not saying that this webinar is not a good thing for you, but most trade financing is B2B. So it is a distributor purchasing from a manufacturer or a sole supplier who manufactures some kind of a part of the whole that's selling to the manufacturer slash distributor. So B2C is not really in that. Then that falls into a different category of MCAs, which are not good and I don't recommend, and other types of financing which you can avail yourself of. What I would say is on that would be that keep track of your sales. So make sure that and this is another mistake that people make, is like, if you get cash at all from any sale, put it in the bank. You need to be able to show that revenue. You need to be able to reconcile your expenses and your profit. And so that when you do go to any type of financing source, whether it's a bank or whether it's a fund, or maybe it's personal friends that you want to expand your business and you want to do a friends and family round, is that you need to be keeping track of that and not going with, I made something great and I sold some of it, and I put a lot of that in my pocket, and so I'm not, or I put it into my personal savings account. So if you're or checking account. So the one thing I would say is, again, it goes to the historical of it. Keep track of all your sales, keep track of your profit margins, do good books.
So much. So I also see a question from Antonio. So here, what are the options when it seems that cash is the preferred payment? Yes, it's difficult to create the back to back in this manner. And
Well, okay, so there's a lot of there's a lot of ways to take cash now, right? So um, obviously, depending on what you're doing. So if you're doing a B2B situation, right, and it's business to business, typically everybody wants a record of the transaction. If you're selling something to the general public or the retail public, then a lot of times that's a cash transaction. So the temptation to take the money and go spend it and utilize that as how you're doing business versus going and depositing in the bank first, that's an issue, and you have to be aware of that. So I mean, I can't, where you don't have, if you can't take it electronically from, some of the international providers that are out there, just depending on what your what country you're dealing with. then you can deposit cash and memo the cash, but you have to do, and it's unfortunate because it's physical and it takes away from what you're doing, and it's one more thing that you have to do. And I understand because I've been in that situation before. I've owned businesses where, I had to go in on Monday with all the cash receipts from the weekend, and take that and deposit it into the bank. And along the way I was buying gas and getting breakfast, and I didn't keep receipts. And well, I made, you know, $1,800, and I ended up depositing, 1,600. Well, that was a bad practice. I mean, I did it. I had most of it because I was careless with the process. But I wasn't looking for financing either, and I was doing enough where it didn't matter. So I understand, again, that can be something there's a lot of temptation in that, but don't do it. If you're a small business and you're trying to build a track record, every dollar you put in the bank is important. It's important to show that.
Okay, so he has a question still. You're saying just find a bank with established trade desk in both the sending and receiving countries.
Uh, well, what I'm saying is, if you're dealing with cash, then you have to be dealing with some kind of fintech system that'll handle that. I think Wise is one on the consumer side. Goes is multiple country. There's a lot of multiple country things, company multiple country software and fintech providers that are out there now. As far as having a trade desk in the sending and receiving countries, well, if they're larger transactions, then they're automatically going to be classified. So I hope I'm answering the question, is that if it's a cash transfer of funds through a banking system, that's fine. I mean, that can be traced. Where the problem comes in is if there's an actual physical cash transaction hand to hand for good or service, and then that money isn't put into the bank. What happens is, maybe it's off book, and maybe there's some tax, there's some tax things that are there, but those transactions don't become part of your physical record of transactional history. So yeah, you want to make sure that your entire system is cylindrical and reporting, so that you can keep track of the process.
And aside from that, saying that, and what bring your supply chain into that bank? Actually, I guess this question is for your answered questions earlier for someone.
What okay, and what brings your supply chain into that? Oh, so if you want to bring your entire supply chain into that bank, I don't think that that's um, uh, necessary unless you want to, and unless you're making foreign payments. In other words, if you want a centralized system, that's up to you. I think what I'm focusing on is just keeping track of the transactions, so that people can underwriters and finance people like myself can see what it is that you're doing, and then there's no behind the scenes play that's going on with larger dollar figures, so that they don't have a KYC or an AML issue, which is something I will cover in another webinar. Can you bring your supply chain into that bank? I mean, that's a voluntary thing. If your supply chain is willing to go to one bank for its payments, that's fine. I don't know. Again, if you have a transactional record, you're okay. Um, I don't think it's necessary to bring your whole supply chain in. But if you're having problems with your current bank, you need to find a bank that is sophisticated enough in international transactions and trade, and make sure you're getting through to the right people there.
Thank you. So I also see a question from him again, Mr. Antonio. So let me go ahead and show it on the stage. So you brought up fintech like digital banks, which seem to simplify currency and transfer even Swift. in real time recently offering credit products. What your opinion on this example, Revel?
I was going to say let's do a one-on-one, and I will do a one-on-one with you. But that is a really good question. So, um, a lot of the fintech providers have teamed up, and they're getting into the game of, offering you financing because they're comfortable with your flow. I mean that's it's good and it's bad. I think you have to look at your contract and you have to look at what your profit margins are without it. I've seen companies use this kind of financing thinking that they were going to flip out of it at an earlier stage and getting their foot caught in quicksand. And ultimately, I watched personally two companies go under by using very expensive financing. So I think that's up to the CFO and the CEO, your C-level people, to determine whether or not they want to actually get into that game. I still think that there's other forms of transactional financing that are easier to do. Not easier to do, but are available, and that goes to the going back to the question of are you packaged up? So it's a lot. If I go to I'm thinking there's Clara Capital, and there's a couple here in the United States. I don't know if they're international, where I can go to them and show them my bank statement, and they're automatically going to open up a line of credit. But on an annualized basis, that line of credit's almost 60 or 70%. So they're purchasing my receivables or whatever it is their contract states, but they're taking money from my account every day or every week. We don't do that, but that is a type of financing that's out there, and the reason that it's happening is because and it's simpler. I don't have to go through a big underwriting process. I can get my money. Their big thing is, look, yeah, we're going to charge you a lot of money, but you're going to get your money tomorrow. So what that plays is into the desperation of the business, and that's unfortunate because then they have to either raise their prices or they have to change their procedures to accommodate that. And it looks okay starting out, but later on it can end up as a death knell. So my personal opinion of that is that a lot of those products are really bad for companies, or they should be only used very, very sparingly. And you shouldn't go back to the well. Whatever you can do to mitigate having to take super expensive capital, you should avoid.
Thank you so much for that. So let's end that question. Oh, what I mean, it's let's take us this last question from Kenton Johnson. So it's have you seen much activity in modular building component (MFG) in Latam?
That's funny because I've got a project in Mexico, and we brought up a modular, and they said no. So, um, it's something that we want to look at. I actually own another company. We consider it a separate division that deals with Mexico and Latin America. Um, and you would think that the economy here would welcome that, but um, from what I see so far, they want to stick with their traditional. It may open up in the future. I'm not saying there's not a market, but from a building code standpoint, and from just how they look at it from a labor standpoint, I'm not sure if modular is one of those things that is going to be big down here anytime soon. Although I definitely see a market for it.
Thank you so much. So okay, so thank you so much for this wonderful presentation, Mr. Jonathan. I really appreciate that. So, and thank you for answering those questions for of our attendees. So, here, before we conclude to the end of this webinar, I'd like to highlight a few important announcements for everyone. So, today's sessions has been recorded and will soon be available on the ITC YouTube channel for your reference. For those and anyone who asked earlier if there's a replay for this, you can definitely watch this webinar on our YouTube channel. And aside from that, if you are not already a member of the ITC, your attendance at today's webinar entitles you to a complimentary membership. Take advantage of this opportunity to connect with our community. And aside from that, participants will receive a certificate of participation as a token of our appreciation to all of you guys. Keep an eye on your email in the coming days for further instructions. So, do you have any final thoughts to share about your presentation, Mr. Jonathan?
Yeah. First of all, I want to thank you for walking through this with me. As you can tell, it wasn't rehearsed. I don't like to rehearse when I do any speaking engagements or anything like that. I will have a brief available for you, and if anybody wants a one-on-one consultation, that's fine. We can do that, and it won't be rushed. It'll be at least a half an hour, and I can go over, what it is that you need to do or what I think the best steps are for you. And then, Lady Ann, if you would go ahead and you can send them or their email addresses to me, or they can send through you a request to meet. I also left a Calendly link, which I will put in again into here. It's at the top, I believe, when you first come in. Let me put it again in chat,
Sure.
and 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 I'll so it's simply put, it's calendly.com at VX Global. Let me put it in the chat, and you can if you want to go ahead and just schedule a meeting with me. I've got available times. More than happy to talk about your individual situation and help you get some sourcing and some other packaging details put in place.
Okay. Thank you so much for that, Mr. Jonathan. So, if anyone or all of you guys, the email address or this is a website, correct, Mr. Jonathan?
Now that's the scheduler.
Okay. The scheduler is already attached within the Q&A tab. So
Okay.
everyone can, or here, Mr. Jonathan, can you please leave your email address as well here on our chat box for our attendees who wanted to connect with you with this webinar can contact you with that.
Yeah. Okay. We're doing that now. One note: if you see that it looks like it's returned, we've got a small issue with our um, email provider, and it's not. I'm getting your emails; they're not returned. It's just something that technically has to be fixed. It started a couple days ago, but that is my email address, and you should be able to reach me there. And you can send me questions, or again, schedule a meeting. I think is probably best, and go from there.
Okay. And aside from that, guys, I will also type in my email address for those who wanted to join in international trade or who not yet a member of the international trade. You can definitely contact me here in this email address. And aside from that, before we part ways, I'd like to express my gratitude to our speaker, Mr. Jonathan Papi, for sharing their invaluable insights today. Your expertise has truly enriched our discussion. So, aside from that, okay, so a heartfelt thank you to all of the participants for your active engagement and insightful questions. Your contributions have made this webinar truly enriching. So keep an eye on your inbox for follow-up information, including the details on claiming your participation certificate. As we wrap up, I wish you all a wonderful afternoon and look forward to welcoming you back to our future webinars. Until next time, take care and goodbye.
Yep. Thank you.
Thank you.